Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in and take a look, see what's going on today. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com. That's where I dive deep into all of these topics, subjects, looking for investment opportunities and sharing that with everyone in the community. I also share everything else that I've learned about the markets and my opinions of what I'm doing. I'm sharing those opinions. You can see it real time with my purchases, and you can track me and see what I'm doing. And if you like what I'm doing, you can also decide to follow me if you'd like. We do have a coupon code special that is giving a discount. It's 50% off the first month only on a monthly membership and a larger discount on the yearly membership. And you can always switch from a monthly to a yearly if you'd like. Special is that code. So against all odds, it says new report, the copper, metals, and mining stock breakdown. We're digging deep into the names leading this breakout and what it means for global equities. If copper is running, growth is expanding, and the miners are confirming it. Read the full report here, and this is copper starting to break out of a resistance level, and it's a pretty big resistance level. So one thing to think about here, there's a couple of things that I see in this chart. This is a double bottom back here, double bottom on the right-hand side, and it blew with no return move all the way up. We're seeing a lot of double bottoms in the market today. Some of them came up and pulled back down like this before heading higher. Other ones, they just blow right through. We don't know if they get pullbacks or not. A lot of people say, oh, we'll just wait for a pullback. There's no pullback here. This one's a big consolidation. It started in 2008, consolidated in three big humps, and then we came on up. This here is a wave one move with a wave two pullback and consolidation. And now we're ready to take off. We could see a big move in copper to the upside here if we can clear this resistance area that we're at. So copper looks absolutely fantastic. Now, if copper's about to run big time here, what does that say about the economy? And what does that say about the people who are trading copper and what they think about the economy? Now, people are going to read leading indicators. They're going to read news reports from analysts and macro this and macro that. This chart trumps all of that. This is positioning of what smart money in the market is doing. And you know what I follow? The charts. And what I do is I aggregate all the chart data up and make a conclusion. For instance, what is platinum doing? That's a very inflation sensitive asset. Well, Andy, it's breaking out. Yes. And what is copper doing? Well, it looks like it's about to break out. And what do you think crude oil is going to do? You think the most inflation asset sensitive precious metal, platinum, starting to outperform gold here? And again, we're early in that move. But if it does start to outperform, I'm willing to bet that crude oil is going to go up. Why? Because they all trade roughly the same. What about fertilizers? Oh, they're going up too. Urea, ammonium nitrate. What about coal? What about natural gas? I think they're probably all going to do the same thing. And they're all interconnected. And how are they all interconnected? Oh, that's right. They're all priced in dollars. They're all priced in dollars. That's what connects all of them. It's a currency thing. You're probably going to see emerging markets break out. I guarantee that's what we're seeing all over the place. And we'll continue to look. Anas says record power consumption at holy sites during Hajj, however you pronounce it, in Saudi Arabia. As I explained over a month ago, this means higher oil consumption. One reason why OPEC plus production increase is not bearish. So OPEC needs to increase production in order to keep exports flat because of internal demand for the country. Over the years, we've seen a lot of growth of Saudi Arabia oil demand. And that demand means less exportable capacity with time. And if they can't increase production, well, it just means you squeeze your exports. You can't export as much oil around the world. What do you think that means for exportable oil in the world? It's going to dry up at some point. The exporting oil for oil is going to get leaner and leaner from some countries. And then we're going to have to figure out ways to produce oil from other areas. I think a big driver um, of less exportable oil and where one country could really maybe take advantage of it, it could be Canada. Could be. And I'm pretty bullish on Canadian oil. Brian says volatility transfers wealth from those who can't handle it to those who can. Think about that one for a second. I read that and I was like, damn, that's true. That's incredibly true if you think about it. Volatility transfers wealth from those who can't handle it to those who can. Now, how do you get better at handling volatility? How does one master it? Well, first, you need to know how the game is being played. How is the game being played? Well, the game is you want to buy when things are cheap. Okay, so when are things cheap? When things become volatile. Okay, so how do I change my mindset to take advantage of volatility than be a victim of it? So the name of the game here, if you learn the game and you study the game, you study it when you want to get good at something, right? So that you start studying, you start um, reading about it or whatever it is. And the one thing you can't really read about is your emotional response to these events or things. A lot of people get really emotional and they follow the herd. It is when you step out of the herd and you start to look back at the herd, you're like, holy crap, these people are they just follow the herd, and it's really, I don't know, it's almost unbelievable how people react and how they behave and how they almost always want to just fit in with the herd. It's like blending in when um, you're blending into the herd so you don't get in danger. Like when a zebra goes out of the herd, a predator can zoom in on it. When they're in the herd, they get confused on what animal to kind of go after, which particular zebra to go after if they're going all over the place within the herd. And I think that's what people feel. They don't want to be outside the herd and take positions when no one else does. They don't want to go against the news or the grain or the sentiment. But that's how you make the money. Position sizing was 70 to 80% of the game. Let me say that again. Position sizing was 70 to 80% of the game. This is learning the game. So Andy, what's the most important thing? Position sizing was 70 to 80% of the game. The reason that struck me is because, first of all, purportedly, George Soros made money on fewer than 30% of his trades. What Stanley Druckenmiller taught Michael Mauboussin on investing. So the name of the game is position sizing. And then finding stuff that's undervalued in the right kind of alignment and then positioning it properly based off of the alignment in the markets or system that you're using, strategies. I use the three-pillar approach. You guys have heard that before. Ratios, technical analysis, and longer-term cycles. Technical analysis because I can't use news to determine anything. I have to use technical analysis to gain my information from the markets on how people are positioning. Big long-term cycles. That's your bigger cycle, which is providing tailwinds and headwinds to certain asset classes. And what I'm looking for is I'm looking for everything to come into alignment. Technicals, the longer term cycles, and then the ratios being cheap against other assets. So whatever I'm in, I want it to be incredibly cheap. That's your alignment. Position sizing becomes the name of the game after that too. How do you line this up? What companies? What vehicles? How much risk do I want to take? And that's the stuff I go over on the website with some of this. Most ridiculous energy bull market ever says absolute state of current oil sentiment. The bank's consensus price target for the next decade is less than $60 a barrel. I am taking the way over on that for WTIC. This is the moment to close your eyes, click buy, turn the screens off. A catalyst will develop to drive it higher. And that's what his opinion is. I don't think we need a catalyst. I think what we need is a lower dollar. And every time in history, when you go and you look backwards, most of these commodity bull markets, they can occur with higher inventory levels too. Go look at the inventory levels of uranium in the 1970s. Tell me they weren't increasing massively. But a lot of people thought that uranium was taking over the world for uranium or for electricity prices, or for generating electricity, I should say. So that's kind of I think a lot of it just deals with money rotating out of financial assets towards hard assets. And that's what I think a lot of it deals with. It's forcing people out of financial assets. If this really is the beginning of a commodity super cycle, there's still a long runway ahead. Are you positioned accordingly? And this is the Invesco DB Commodity Index. The big move, there's your double bottom. That double bottom I showed you, remember that? And then we have a breakout, and then we've been consolidating in what looks like to me a wave two, which will get a big move to the upside coming up. We'll dust this top here. We're going to dust that. We're going to blow right past that at some point. But right now, the Bollinger Bandwidth, yeah, at historic lows. From volatility contraction comes expansion. Yes. And then a big move. Bam. Caution. Home buying conditions have collapsed. It has fallen to levels seen only two times since 1960, 74 and 81. People don't feel like buying homes. Well, the thing I don't understand, so I'm all data-based, engineering, math, statistics, uh, quality control charts, all that stuff, right? And then when I look at all the economic side, it's like sentiment charts. And I'm like, well, sentiment, well, people don't feel like buying homes. Like, how does that data, how does that like mean anything? Because someone doesn't feel something doesn't mean that the conditions will automatically change. What if it gets worse? What if home prices become unattainable? You think people are going to feel like buying a home then? Oh, I can never buy a home. That's kind of what they're going to say. So I mean, we'll see what happens. And this obviously shifts all over the place, but right now it's really low, one of the lowest times in history. Jamie Dimon of J.P. Morgan says you're going to see a crack in the bond market. It's going to happen. I'm telling you, it's going to happen, and you're going to panic. I'm not going to panic. So, what happens when you get a crack in the bond market? This is what will happen. You're going to see interest rates spike. When you see interest rates spike, I think the stock market's going to get kicked in the face. I do think that maybe it all depends how it goes down. Um, we could see selling across the board is a possibility if there's margin calls and stuff like that. Um, there could be a run to precious metals that's safe, a run to safety. It's tough to say exactly how people will respond to it, but I do think that it'll be a huge headwind for regular S&P 500 and NASDAQ and stocks like that. I'm not sure how commodities are going to react to that. It depends how much those interest rates go up and how fast they go up and what that kind of does to the market. Silver's breaking out from a 45-year formation, and you guys obviously, we've gone over this a lot, and people are locking in profits on day one. This is why most people will never make life-changing money. And a lot of people have been asking me, what should I do? And I can't answer what you should do, but I can tell you what I'm doing. Guys, this just broke out. Like, this could be an insanely big move. So, patience, calm down. Some of you guys get pretty giddy if you're up 300-400% on an individual stock, almost like maybe you've never had that amount of gains. What's coming is going to be big. And if you're in it to make life-changing money, well, You can't sell everything at a 300% gain. You're hoping that you can add another zero to the end of that. Hopefully you get a 3,000% gain. Take 30 times, multiply it by your cost basis. If you've got a low cost basis and you're part of the website, look at that valuation. It's not going to be easy to get there. You're going to experience a 40 to 50% pullback along the way. It's going to scare you a couple of times if you're going to go for life-changing money. That's what's required to play this game, unfortunately. And if you're going for life-changing gains, most of the time, I mean, sometimes it can go straight up to the number that you want. That would be a very, very easy ride. But a lot of times, since the markets move in waves, you get pretty nasty pullbacks during a section moving up. You'll get an impulse move, a consolidation, impulse move, consolidation. And those consolidations can be 30, 40, 50% pullbacks if you're in a stock that is going to move 30, 40, 50x. So get ready. Mentally prepare for it. Do not get discouraged. Do not get surprised by those pullbacks when we get them. Anas says, one irony of oil and gas sanctions and promoting U.S. oil and gas over Russian, Iranian, and Venezuelan oil is that it preserves reserves in those countries for the future while depleting U.S. Norwegian reserves. List the implications below. Think about it. And that's true. If you put sanctions on this, they just preserve their oil for future use. And then deplete everyone else who doesn't have sanctions on it. That's kind of a win-win. Obviously, if you're making a bunch of money from something that you're selling, that's good in the short term. But in the long term, that might be pretty good if you're keeping all those reserves in the ground for a period of time and use them in the future. It might be more valuable in the future too. Warren Buffett says the important thing is to keep playing, to play against weak opponents, and to play for big stakes, says Warren Buffett. Here's another one from Ben Graham. He says the essence of investment management is the management of risks, not the management of returns. Well-managed portfolios start with this precept. Benjamin Graham says that. And I'm going to just make a comment here. What a lot of people do is they say, well, how high can this go? And then they go and they're like, oh, I can handle the risk. That's not the right mentality. Mentality is, how much risk am I taking on and what are the returns that I can get? Then you start paring down your investment options. Okay, I've got 5 options. They all can go up roughly the same, but this one's got way less risk. Now, how do you measure risk? It's pretty opinionated. So here's something that I think people also, fail to recognize. I hear people say, oh, well, that was a really good investment. It went up 5x. It may not be a good investment. Just because the outcome was good doesn't mean you made the right decision. So if there's something that is incredibly risky and it happens to work in your favor, that doesn't mean that you're making consistently the right decisions. So when you look at the markets and you say, okay, I can take a portfolio of possible investments, what you want to do is if you can make a portfolio that in the portfolio of the companies that you own, you can more consistently hit higher returns with less risk, that portfolio is better than ones where it's like a shotgun approach with a ton of high risk and your returns aren't as good as the other one. So it's about, some people will look at something and it will go up a lot and they'll say, oh, I should have bought that. Maybe not. And I'm in the camp where it's like, okay, how much risk do you have to take on to get it? And is it worth the risk? Just because the outcome was a favorable outcome in one instance doesn't mean that you should be running the portfolio consistently, taking on as much risk as maybe some people do. Now, a lot of the high risk companies, they might all work at the same time when the market conditions change in favor for that sector. And it might be a very good profitable time, but it doesn't mean you put all your money in it. Timing the market is very difficult, and a lot of the times, if you're in high risk stuff, and what that means with high risk, the way that I define it, it's a company that doesn't really make any money. So when money flows in, it goes way up, and then when money flows out, it goes way back down to like zero. So it comes in, it goes out, and then the stocks go back to being dead again. So it's really just money flowing in and money flowing out. Company that can sustain high earnings will give you valuation, and valuation sustains high stock prices over long periods of time. So that's kind of the way that I define it. Here's crude oil. Point and figure chart suggests $72 in a breakout here of a double top breakout is what they call it on point and figure. Bullish trend says bankers need to go back to school to understand this. The current oil price can't last for long. Their predictions and tea leaves are worthless. Well, I don't know if that's the case. I mean, they can last for a period of time, but all you have to do is look at valuation. Is oil cheap to gold? Yeah, it's incredibly cheap. Good deal. So, can we predict where prices go? I think that's tough. But can you know with certainty if oil's cheap against gold? It for surely is. 100% certain that it is. So that's what you go off of. You go off of things that are certain versus things that people are trying to predict. Howard Marks says psychology swings much more than fundamentals, and usually in the wrong direction at the wrong time. Understand the importance of resisting those swings. Profit if you can by being counter cyclical and contrarian. The quote above, understanding the game, and the quote up here, which is, if I can, volatility transfers wealth from those who can't handle it to those who can. That is exactly the same quote that I just read down here, said differently. Psychology swings much more than fundamentals. Profit when you can, being counter-cyclical. It's to those who can handle volatility versus those who can't. And then knowing where the value is. If you know that your price is way underneath your value, maybe that gives you conviction. So you need to know a couple of things. What's undervalued? What's overvalued? How do you define it? How do you look for it? Is the Conference Board LEI leading? I think that's leading in economic indicators no longer useful. I believe they thought the same thing in the late 1990s. According to this chart, U.S. markets appear decoupled from the underlying fundamentals just as it was back then. The Conference Board Leading Economic Index is a predictive tool that anticipates turning points in the U.S. business cycle. That is, of course, at 2000, which was the bottom of the commodity bull market. And where we are here, we're at the bottom of the commodity bull market. It's the same exact situation. Your cycle, real estate cycle, is driving this. We went into a big real estate boom here, and then it was a recovery phase. We could go into a big real estate boom. I know that's not the popular opinion, but it depends on what interest rates do. Depends on QE, depends on some things here. And it might even depend on the psychology of people getting used to higher interest rates. I know, I may sound crazy. And you know what? Most people are wrong most of the time. Remember last year when analysts on BNN were telling us to almost avoid Canadian banks? They almost nailed the ultimate bottom. Well, yeah, that's what it is. All the news, they just go around chasing sentiment. U.S. Treasury yields could hit 7%, and that would be catastrophic. Wall Street's worst case scenario is closer than you think. This will affect everything, your home, your job, your future. Yeah, I mean, unless you already own a home and you, it may impact your job, maybe. And it may impact your future, maybe not. I think it's the cycle. The cycle's turning. It's the way it is. You're going to have to deal with it, and things will change. This is insider buying of Canadian oil and gas stocks have soared 54 million. They're just loading up for Canadian oil and gas. They're loading up, baby. This one here is bond erosion is the canary in the coal mine. Few understand this. Prepare for 10 to 15% mortgage rates in the absence of an equities bloodbath. Hope this helps. US 30 year, this is a cup and handle, ready to break to the upside perhaps. This one here is the US 10 year on the bottom there in this pattern, and we're ready to maybe perhaps break 4.7 to the upside. So I know Bissett wants to keep this under 4.5 on the 10 year, but I don't know. We'll see. We'll see what happens here. This one says another remarkable week for silver. We're likely in the early stages of a new secular bull market for the metal, in my view. Of course we are. For sure. For sure we are. 100% agree with Tavi there. That's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use that special coupon code, and that's all I've got for today. We'll catch you next time. This is Finding Value.